All right, today we're diving into a really fascinating briefing from Resolute Consultants. It's all about India's K-12 education sector. And listen, this market is going through a huge shift. It's built around this central paradox that's changing everything for millions of students. And, you guessed it, creating some massive opportunities for investors. So, let's get right into it.
So let's just start with this one number, $144.2 billion. I mean, just let that sink in. That's what Indian parents are projected to be spending every single year on K-12 education by 2030. It's actually the fastest growing education market in the world. But, and this is a big but, behind that explosive number, there's a huge contradiction.
And here it is, the big question we're going to unpack today. How on earth is this market booming, almost set to double, when the actual number of students is, well, it's shrinking? It just doesn't seem to add up, right? Well, the answer, it turns out, has to do with a kind of broken promise, something deep at the core of the Indian education system.
Okay, so to really solve this puzzle, we've got to first understand the core problem. And what the Resolute report points to is this idea that the whole system, it's basically built on this old industrial era model. Think of it like an assembly line, one that's now pretty much broken.
You know, for generations, the deal was pretty simple. The social contract was, you send your kid down this 20-year conveyor belt of school, exams, rote learning, and at the other end, they'd come out with a great degree and a safe, secure job. But here's the key takeaway from the report. That deal? It's off. That contract is broken. The skills that this old assembly line cranks out just don't match up with what the modern economy actually needs anymore.
Yeah, and this quote from the report's author, Aurobindo Saxena, just puts it so bluntly. We are currently valuing a market that is largely built on selling a defunct dream. Wow. I mean, the market's huge valuation is tied to a promise the system just can't deliver on anymore. And this is the really critical part to understand. Even if the dream is dead, the spending that dream inspires, oh, that is very, very real.
All right, let's dig into the actual data now. This is where you can really see those two opposing forces, fewer students, but way more money, clashing head-on. So, first up, take a look at this. The trend is clearly pointing down. Total K-12 enrollment, it's dropped by more than 18 million students in just 3 years. Now, some of that, to be fair, is just data cleanup, getting rid of phantom student records, but a big chunk of it is a real demographic decline. So, there you have it. Part one of our paradox is confirmed. The student population is definitely getting smaller.
But here's where it gets really interesting. At the same time the whole student pool is shrinking, there's this huge migration happening within the system. Just look at this chart. On the left, you see government schools losing over 14 million students. And on the right, private schools are gaining almost 12 million. What this tells us is that parents are literally voting with their feet and, more importantly, with their wallets. It's a massive shift towards what they see as better quality.
And this right here, this just hammers home the challenge the market is facing. It's a demographic headwind. The pipeline of new kids entering school is simply getting smaller. We're looking at a big drop in the school-age population by 2030. So it brings us right back to that question that seems impossible to answer. How can a market grow when its customer base is shrinking?
Okay, so we've laid out the paradox perfectly, right? A shrinking number of students, but a market value that's just exploding. So what's the answer? Well, the report says it comes down to one single, incredibly powerful engine driving all this growth, and that word is premiumization. Let's break down exactly what that means.
And here it is. This is the big aha moment that solves the whole puzzle. The growth isn't coming from more students, it's coming from more spending per student. I mean, just look at this. That tiny little sliver on the left, that's the premium and super premium schools. It's only about 3.6% of all students, but that tiny group accounts for over 40% of the entire market's value. That's just incredible.
So to get a handle on this, the report breaks the market down into 4 different tiers. You've got the mass or budget segment, where fees can be less than $200 a year. And then you move up through prestige and premium, all the way to super premium, where you're talking about schools charging over $30,000 a year. The entire growth story, all that money, is happening at the very top of that pyramid. It's all about a growing number of affluent parents who are willing to invest a ton of money for what they believe is a better shot for their kids.
And this chart? It just drives the point home even more. Take a look at the bar on the right. That represents schools with international boards. They only have about 2% of the students, a tiny fraction, but they pull in 23% of all the private school revenue. Now compare that to the bar on the left. These are the private schools with state boards. They have the vast majority of students, 61%, but they only capture about 28% of the revenue. That extreme concentration of value, that is premiumization right there in a nutshell.
Okay, so given this new reality, this focus on premiumization, where's the smart money going? The whole investment strategy is shifting. After a huge correction in the market, capital is now flowing into totally different kinds of models.
But to understand where money is going now, you really have to understand where it just came from. And the backdrop is the great EdTech bubble bursting. I mean, funding just fell off a cliff. It dropped 96% from its peak in 2021. That whole speculative craze around online tutoring apps sold directly to parents, well, that bubble has popped. And it's forcing investors to look for something much more sustainable, something with real assets behind it.
So where is that capital landing? The report highlights 4 key areas. First are these Phygital models. Kind of a funny word, but it just means combining physical schools with digital tools, the best of both worlds. Second, you have B2B platforms, so companies that sell services to schools instead of to parents, which is a much more stable business. Third is what you'd expect, sophisticated AI-driven learning tools. And last but not least, we're seeing big, organized school chains buying up smaller independent schools. A lot of consolidation.
And you know, this chart here, what they call a value bridge, it just sums up the whole story perfectly. If you follow it from left to right, you start with the market's value today. Then you see the green bars. Those are all the things pushing the value up. And look at the biggest one, fee premiumization. Then the red bars. Those are the headwinds, the things pushing it down, mainly that drop in the number of students. And when you balance it all out, what do you get on the far right? That massive growth to over $144 billion. It's the whole story in one picture.
So we're going to end on this one really critical question. The data is clear. We're seeing a market that's creating an enormous amount of financial value, but it's super concentrated at the very, very top. So as this gap gets wider, you have to ask, is this education gold rush actually creating more opportunities for everyone? Or is it just building a permanent two-tier system that ends up leaving millions of kids behind? That really is the big question that everyone involved, from investors to policymakers to parents, is going to have to grapple with.